we're going to talk about some what if scenarios. And you see, I have one very specific one highlighted here, which I think is extremely important. I have sort of a personal attachment to this as well. With my father-in-law, he was diagnosed with, a very rapid form of dementia. It was like a 1 in a million chance that anybody gets this disease. We got his diagnosis, and within, 8 months, he had passed away. And he went from being his normal self to a month later requiring in-home care. And because, unfortunately, they didn't, obviously, this was an unexpected event. The guy was 65. Who's expecting to pass away or develop something at 65? Nobody, right? He's expecting to just step into his retirement. Unfortunately, they didn't have everything in place that they maybe should have, and they had to rely on, the public healthcare system. And when I tell you, this was wintertime as well, having to deal with the number of cancellations, the number of rebookings, the number of phone calls to try to get somebody to the house to take care of the guy. It was insane. So we want to make sure that, especially for my client base, I never want any of my clients to have to go through that or their family to have to go through that. So it's very near and dear to my heart that you have those contingency plans in place, because when you have an unexpected event like a serious health concern, the last thing you want to be worried about is your finances. So if we can make sure that we add certain parameters into place while we're still working on your financial plan through different stages of life, we're absolutely going to talk about it, and hopefully we get the right things in place. So there's a few different what if scenarios. Obviously, if you've been working with me and I've been managing your investments, you know that I talk a lot about downside protection with your actual investments to make sure that should you need money within a specific period of time, we're not having to necessarily scramble if the markets are, declining at that time. I'm going to, just flip over to the next slide and give you some numbers with regards to the health risks. So should anything happen where you require any sort of in-home care, a lot of people aren't aware of how expensive this can be, okay? So if we take a look at private in-home nursing, these are the monthly costs, $8,000 to $12,000, okay? So if you have $500,000 in your RSP, $1 million in total savings, even with that said, those sound like big numbers, but when you start adding 8 to 12 grand a month for potentially multiple years, your retirement savings can be depleted pretty quick, okay? So we need to figure out what is an additional way that we can make sure that you have a sufficient, amount of money that doesn't necessarily require you to give up more cash flow today. So that's what we're going to be diving into. One more slide before I pass it over to Christy to talk about the actual product. Now, I borrowed this slide and these sort of graphs from a critical illness illustrator, but I think it's still relevant to the product we're going to talk about today. So this is basically illustrating, the black line is, basically your retirement savings today, and assuming that nothing happens in life. So no sort of health concern, no additional costs required related to a health scare. Scenario 2 is the green line, right? If you have some sort of contingency plan like a critical illness or some other solution that will allow you to draw money from without having to rely 100% on your retirement savings. Now, the red line is if you have nothing in place and you just have your RSPs, TFSAs, just your investments that you're relying on. If you're forced to draw money from your savings prematurely before age 65, right? If the markets are down, that can be a very bad scenario for the longevity of your savings. The last thing we want to see for anybody is you're living longer than your savings, because then how can you afford to live, right? You don't want to rely on the government income because it's not enough. So this is why we have these tough conversations early, right? While we still have the solutions available that we can get you access to make sure we're not having to deal with those tough scenarios. Because again, the last thing you want to worry about is money when you're dealing with any sort of health concern. We hope to God and pray that none of this ever happens, but my job as, your financial professional is to make sure that I make you aware of these solutions should anything happen. And if this is something that maybe you've seen, friends and family members maybe deal with, it's extremely important that we have those conversations. Okay, so that's it for my sort of rant. Christy, I'll pass the floor over to you. I'll stop sharing here, and hopefully you have the ability to share. And I see your slides already, so that's perfect. So Christy, take it away, please.
Okay, thanks, Bronson. So yeah, what we're going to talk about today, my goal is to help you just shift the way you think about money and your retirement. And we all want to make sure that our retirement plans are solid and can handle whatever life is going to throw our way. So what I'm going to do is show you how Manulife One can really be a game changer for you there, giving you flexibility and control over your finances, helping you maybe if this is your situation, manage debt, if that's your own individual situation, helping you save on interest and really set up a strong retirement plan. So you guys can see the screen there, okay? Perfect. So most people know Manulife for insurance, investments, group benefits, but yes, Manulife does have a bank, and our bank was established in 1993. Now our flagship product is called the Manulife One. This is a line of credit that is secured against your home, but it's not just a typical home equity line of credit, HELOC. It's far more flexible and can play a key role in your retirement plan by giving you easy access to the equity that you've built up in your home, your home's value. But, you know, a lot of you might be thinking, well, Christy, I worked really hard to pay off my mortgage. I don't want debt again. And that's fair. I get it. I don't either. But Manulife One, we're not talking about creating debt. We're talking about creating options. Okay, this is a safety net for some of life's surprises, you know, some of the things that Bronson had mentioned that we hope to God doesn't happen, but let's be prepared for it if in case it does. Well, the good news is that people are living longer and more active lives. This is great. But that also then means that many Canadians worry about outliving the savings that they have. Nearly half of Canadians now feel less confident about their retirement than they did even 1 year ago. So even if you feel prepared, it's really smart to have a backup plan in place. And we all know that life does happen. Now, some things maybe you have planned for, those trips, right? Other things maybe not. And some of those common concerns that we hear from clients are, what if the markets drop and my investments really start to tank? What if I get sick or my family member gets sick? We saw those stats on the care that's needed, the cost of that. What if our kids need money, whether it's to help fund their education or even just to penetrate the housing market, right? Chances are one of these will be your and my reality as well. I think of, you know, how are my kids going to buy their first home? Is really difficult in this market. So I just want you to keep some of these points in mind while we go through the presentation. We're going to revisit it at the end. Now, many parents end up helping out their kids financially, and the stats show that homeownership amongst Canadians age 18 to 34 has fallen sharply over the last few years. We're dropping from 47% in 2021 to a staggering 26% in 2024. I can't imagine those stats would be looking any better for 2025. Now, a 2024 survey revealed that 50% of parents anticipate helping out their children financially, but most of those surveyed actually express their uncertainty and how they're actually going to facilitate that. And 61% of Canadian parents prioritized supporting their children's education over their own financial well-being. So many of those people willing to delay their retirement just to be able to help out those children. Now, your home is where your heart is, but it's also comforting to know that this is a substantial part of your personal wealth. And it's an important asset that can benefit your retirement lifestyle. But what's the best way to tap into that asset? Even if you're confident that you're financially prepared for your retirement, it never hurts to have a backup plan. And Manulife One is going to allow our clients to have easy access to the equity that they've built up in the home, up to their borrowing limit whenever a need arises. And because this account actually acts as your day-to-day checking account, as you can see on the screen, accessing that home equity can be as easy as, writing a check out of your checkbook or transferring money from the Manulife One to, let's say, your account at TD, if that's the case, or even just using your access card that we give to clients. But what makes a Manulife One such an effective backup plan? Well, there are no withdrawals required. So if you have it set up, you don't have to take money out of it. And even if you do need to take money out of it, there's no minimum withdrawal amount. It could be $1, 50 cents. And any withdrawals you do decide to take are not taxable. And you're free to pay back that debt on the line of credit at any time. You get to see a list of your transactions through our online banking that we have or our monthly statement that we give clients. And one thing to note here that you may or may not be aware of, but title fraud been pretty significant over the last few years with homes that are mortgage free. I know this has actually been a little bit more prominent in the GTA area, but it has hit other communities as well. So just know that securing a Manulife One against your home, it actually does offer a barrier of protection and reduces the chances of you being targeted from those fraudsters. So it's just something to keep in mind. Now, if your account has a positive balance, so no money owing, and you actually are in the positive, you earn interest on every dollar that's in that account. So you're going to see an interest deposit into your account at the end of each month. That interest rate is currently 1%. Now, to be open to this approach, there better be some big benefits in it for you. And
Can I ask
there
a quick question, Christy?
Yeah, absolutely.
So that account that you're describing can be used like a checking account. Is that right?
Correct. Absolutely.
What do other banks pay on checking accounts for holding money in there?
Typically, a checking account doesn't have an interest. If it is, it's like 0.0001%. Even a typical savings account at another financial institution, so their high interest savings account, is still 0.01%. It's typically a tiered, you're only getting that on the first 10,000 or 50,000. So, I've been down that road. It's very defeating when you see an interest posting of 3 cents into your savings account.
I have seen, I won't list the banks, but certain banks market accounts as high interest and they pay less than 1%.
Yeah. It's just wild. So it's comforting to know that with Manulife One, if you are using it as your everyday account, every single dollar that you have in there in a positive balance is earning you money. And a competitive rate at that. But the real benefit here, I think, is helping Canadians stay in their homes longer, giving them options and extending the life of their other investment assets. And nobody wants to pay the tax bill more than we have to, right? Remember, home equity, that's a tax-free income source. This means that maybe you can redeem less from a taxable income source like some of your investments and avoid an OAS, an old age security clawback, or avoid bumping you into a next tax bracket. So you can really get creative with your financial advisor on how you want to draw that money. But the real value here is helping you stay where you want to be and giving you options. And my own personal experience with this is my grandmother. So she lived in her home into her 91st year independently. So as she aged, she had a PSW worker come in once a week to help out with things. But in the last few years of her life, that actually had to increase to twice a day. So PSW coming in a couple times a day in the morning and in the evening. And you can imagine the financial strain that that would cause. But she was able to do that without a financial strain because she had the flexibility of Manulife One, and she was able to tap into the equity in her home and remain exactly where she wanted to be among her friends, in her community, with all of her plants in her house in the final years of her life. And that to us was really what we wanted for her. Now, some people may be contemplating downsizing at some point, moving to a perfect bungalow or a condo, or maybe purchasing a second property. So these are all things to think about. In terms of downsizing, I've had a number of clients where they're retired, they're on a fixed income, they're looking to downside. They assumed because their home was mortgage free, there would be no issues with purchasing that new, smaller home. Well, that original home didn't necessarily sell immediately, or the client wasn't ready to put it on the market. They wanted to paint and do this. And it really put the clients in a difficult position, and they weren't able to afford to hold two homes simultaneously. Not only that, those clients weren't able to obtain bridge financing. So just a side note here, to get bridge financing, it's a pretty common thing when you're buying and selling, but you actually need a purchase and sale agreement, not only on the home you're purchasing, but also on the home that you're selling. And I'm hearing about a lot of homes staying on the market. Things aren't moving as fast as they once were. We're obviously a little bit more in a buyer's market at the moment. So I asked, how can Manulife One fit here and help avoid this?
Well, Christy, can I jump in for 1 second? And I have two sort of questions.
Yeah.
So first, well, I'll peg the first one for later, but can we just maybe explain what exactly is bridge financing? We have some people on the call who may have only ever purchased a home, have never had to downsize or sell. You may not be aware of what that actually means. So if you could just describe that in more detail, that'd be great, please.
Yeah, absolutely. So typically, it's an arrangement that a lender is making with a borrower, and that borrower is moving from one home to the other. But in order to do the bridge financing to cover the cost of, let's say you're selling on this day, but you're buying on this day, nothing's really matching up on the same day. So there's a bit of a gap. And that's where the lender says, oh, don't worry, I will cover that gap for a week, a few, whatever that gap is, and you are good. So then now you have time. You can slowly move into the new home or whatever the case may be. But in order to do that, there needs to be a firm purchase and sale agreement on both sides. It's really the lender agreeing to cover the shortfall, the gap in terms of when your home's selling, when you're buying, and dates aren't necessarily matching up, which is generally, something that you do want to try and consider, because trying to leave your house and get into the new house all on the same day, very stressful situation. I just moved recently. Fortunately, I was able to do that bridge financing. So I had a few days to really get into the new home, get the old house kind of cleaned up, ready for those new buyers. So it's really just giving you some time.
For sure. So this comes into play when basically you're closing on your purchase prior to your sale. So that basically the bank will give you two mortgages at once. And once you sell the property, you get rid of the first mortgage.
Yeah.
Now, my other question that I had from a client come in was, can you just describe the difference between Manulife One versus a traditional HELOC? I know there are other companies out there that have something similar to Man One, but I think Man One is still unique. So if maybe you could just in a concise manner, just say, what is the actual difference with Man One versus a standard HELOC?
Yeah, because that's a great question, and something that is important to note on how we are different. So with a standard HELOC or any other line of credit for that matter, you always have to make an interest-only payment on that account. So you have a minimum payment each month that you have to make on that HELOC. With Manulife One, where we're uniquely different, is that we actually don't require clients to make an interest-only payment. We also allow clients to use the Manulife One as a fully functioning checking account. So none of the other HELOCs will allow you to do that, to have your income directly deposited in, to have an access card and pay your bills out of that HELOC. That is something that is unique to Manulife One as well. Does that help answer that question?
Absolutely. Yeah, absolutely. Thanks for that, Christy.
No problem. Now, with Manulife One, remember, you're now tapping into your home's equity. So maybe the value here is helping you to be your own banker for that new purchase, right? If you have access to enough equity in your home for the new purchase, you can take bridge financing and having to qualify for a new mortgage for that new property out of the equation altogether. You simply get to write a check out of your Manulife One for that new purchase or for that second property. Let's say it's a property in the US, like good luck trying to get any financing for any of those properties. Well, if you have access to the equity in your home, you're your own banker, right? You can write that check. There's no more qualifying with a lender. You take that out of the equation. So your real estate is a part of your overall net worth. So I always ask, why isn't it an active part of your retirement plan? So the traditional approach to retirement, as you see on the left-hand side here, that generally relies solely on your investments. Now, not all, but some investments do have some type of tax implication, as we know. And as you can see here, a large part of a person's net worth is their real estate. And maybe it's not benefiting them or their financial picture today, right? Where you look at the diversified planning approach on the right, it shows how you can maximize some tax efficiency by utilizing your entire net worth, your home, that real estate, to help fund your retirement. Let's look at that a little bit deeper. So why would cash flow in retirement not look like this? When it's diversified, now you have options. You have extra levers to pull income from more sources. So as we talked about, what happens if the markets dip and your investments are down significantly? Well, maybe it makes sense just to take minimum RIF withdrawals, supplement the rest with from the Manulife One, from that equity in your home, again, which is tax-free. Remember, you can use it to strategically stay within a tax bracket as well. Now, the secret to this solution is to put this in place before you need it and while you can get approved for it, opposed to needing it down the road and not being able to get that approval. I've had instances where an advisor has come to me on the client's behalf looking to put the Manulife One in place because they really needed access to it, the financial hardship, some type of unforeseen circumstances. Now, it's not, unfortunately, in some cases, it's not something we're able to facilitate because the client was in such a bad financial state, they weren't able to qualify at that time. Maybe if they talked to us 5 years prior, 10 years prior, we probably could have been able to qualify that client. So just to reiterate, it's important to put some of these strategies in place while you're in a strong financial position. So think of it almost like insurance. You don't wait for the heart attack to apply for life insurance, right? You want to be proactive. The same thing goes for credit. Now we've gone through sort of why it might be important to put this in place. Let's just review a quick little case study if that's good with you guys. My Uncle Sean, he's 65, he's about to retire. Let's run through some numbers to see what this looks like for him. He'd love to get an extra $750 a month in income to help support his retirement lifestyle. His home is free and clear, so he owes nothing on that. The house is worth approximately $750,000. So I'm going to make a couple assumptions here. The Manulife One, that open line of credit interest rate is currently prime plus 0.5%. So that today is 4.95%. Now I know this screen shows, I believe it's 6.45%, but I like to keep it at the higher rate. This is a bit of a stress test, right? Obviously, that rate can move up and down with the Bank of Canada when they make their interest rate announcements, but I like to keep it a little bit higher just as a bit of a stress test. And let's assume that the value of the home goes up on average of 3% a year. Could be more, could be less, but this is somewhat conservative estimate. Now, just to recap, Uncle Sean's looking to get $750 a month, works out to be $9,000 a year in income, tax-free. He also owns that $750,000 home. There's no debt owing on it currently. So based on this information, he's actually able to draw that $750 a month or $9,000 a year, tax-free for just over 23 years. So although interest does accumulate during that time, Sean doesn't actually even have to service the debt in that time whatsoever. He can, but he doesn't have to. He has that borrowing room. But what happens after 23 years? Because he's still a young guy, I guess. At this point, he has a number of options. He can apply for an increase to the borrowing limit since the value of his home and his equity would have grown in those 23 years. He can make payments to the Manulife One at any time to ensure he remains below his borrowing limit. If he chooses to sell his home, he would pay off his line of credit from the sale, and he would still make $995,623 from the sale. So let's just break that down a little bit further because I am a visual learner. On the left, the image showcases what your home value is and borrowings are in year one, according to your Manulife One setup. And on the right, it's going to show the borrowings and value in year 23. Green bars are the total value of the home. Remember, that's increasing at 3% a year. And after 23 years, that home's worth almost $1.5 million. Now, by taking out that $750 in cash a month for the 23 years, not making any interest payments on the money, the total borrowings sit at $484,567. But the home is now worth $1.5 million, and they've only borrowed $484,000. So when we subtract that, we can see that they still have over the $995,000 in home equity available. So I think it helps for some clients to see sort of that broken down in that way.
Christy, can I, this is just for my own brain, and maybe, I won't say the name, but I know where someone else's head is at. Can we go back on the slide? And
yeah, for sure.
Based on my assumption, over, well, I think I got like 277,567 would be attributed to interest of the total borrowing. Does that sound about right?
Yep, that sounds about right.
Okay. Yep. Because the way I look at it is 9,000 times 23, we get 207. So the change there must be the interest. If we look at the 5-year total return of the S&P 500, it's 82% over 5 years. I'm comparing 23 versus 5. If we take a look at, going back to 1996, if you had invested in the S&P 500, which is basically our best representation of the US stock market, that's an 820% return over the time period. So even though it's a lot of interest, if you kept your money invested and you paid the interest, you'd be wealthier. Okay? So whenever we take a look at, thank you. Whenever we take a look at, should I invest or continue to invest, or should I borrow money for any situation in life? What you have to look at is what is the expected interest rate versus the expected rate of return by investing. The long-term average of the stock market is 10 to 12%. If we're looking at a 5% borrowing rate on the HELOC, that's a spread of 5 to 7%. So that makes you 5 to 7% richer on average per year. Okay, so in this case, if that's what you're wondering, the answer is if you're going to invest aggressively, that would be the way to go. Keep the money invested and borrow some money. Even though it's kind of like, I don't want to be paying so much interest. If you take a look at it from a numbers perspective, it makes sense to continue to invest.
Mm-hmm. Definitely.
Sorry to steal your sharing there.
It's all good. I'll reshare. Because it's a good point. We do have a lot of advisors that utilize Manulife One with clients, almost like, an investment loan. So that borrowing strategy as well, like taking, 10,000, 50, whatever it might be out of the home equity, dumping it into the market and carving out that debt into a separate, we call them tracking sub accounts for CRA tracking purposes, and naming it investment loan. So there's so many different strategies, and I don't want to go down the rabbit hole, go off topic too far with it. But there's so many different strategies that you can do with this product because it is so versatile. I just want to go over some of the common questions that we hear from clients. One of the big ones is, am I forced to use that line of credit if I don't need it? And answer is absolutely not. A lot of our clients will set up the Manulife One and may not touch it for years or if ever at all. So there's no requirement for you to draw on that. If I need to pull out cash, what is the repayment cost? Probably one of the most important questions. So we talked about that. That interest charge on the account is prime plus 0.5%. Today, that's 4.95%. However, unlike the traditional HELOCs out there that we talked about, where they force you to make that interest-only payment, with Manulife One, there's no required payments as long as you're under your borrowing limit. So as we saw, a lot of retirees can use it to take a small monthly income payment. So you guys are a virtual bank. So how do I get access to money? So Manulife Bank is part of the Exchange Network, which is the second largest ATM network in Canada and the largest in Ontario. So this is actually most commonly found in credit unions. So think Libro, Meridian, Windsor Family Credit. National Bank is part of that as well. You receive a debit card you can use at these ATMs at no cost. You can use those debit cards for point of sale purchases. You can write checks, e-transfers, bill payments, essentially all of the banking transactions that you're used to doing with your bank, you can do with Manulife Bank. I want to leave my house to my children. So this is a common one that we hear, and you still can. You still get to. It's your house. You get to choose what you want to do. But I do like to just make a little side note. Remember, we're living longer. So you may be leaving your house to potentially a 60-year-old child. Chances are that 60-year-old child has their own home already and may be looking to sell your home. Most children would rather see their parents using home equity to live comfortably and have a comfortable retirement. So you can still leave your home to your children, absolutely. Like we showed you in that last illustration, your children are going to get the remaining equity that's in your home once that line of credit is paid off. So what happens if one of us passes away? Will my spouse lose the home? And this is an important point because unlike most HELOCs on the market, if both spouses are on title and one passes away, we actually don't make that surviving spouse have to requalify. So I do challenge people, if they have a HELOC with their existing lender, ask them that, especially if it's the breadwinner financially in the home that passes away. Are they going to come back to you and reassess your borrowing limit? Because I've heard of that happening time and time again. As a very difficult time in people's lives, and all of a sudden the rug is pulled out from under them and they realize they don't have that $200,000 limit anymore. It's been reduced. So with us, Manulife One stays in place. Borrowing limit does not change. Very important. What if I have an existing mortgage and my home isn't free and clear? And we're seeing that a little bit more. We take care of payout to your existing lender. So that just means that your Manulife One account starts with not a zero balance. There's going to be an amount owing. So we do all the communicating and working with your existing lender for that. Now, what will it cost me? So there's no setup fees at all with the Manulife One, but I do want to let you know that there is a monthly fee on the account of $9.95. or it's $16.95 if you're under the age of 60. So we give people 60 and over a little bit of a discount. However, there is great news because right now we have a promotion. If you apply for this account before June 30th, we're waiving those monthly fees for 3 years. However, just know that if you have no debt on the Manulife one, this is a what if account, it's sort of a backup plan that you have. If you have 5,000 in the account in the positive, so you're in a positive balance, we actually waive the monthly fee for those clients as well. So some people ask, so this kind of sounds like a little bit of a reverse mortgage. And I do want to go through just some quick fundamental differences because it sounds like some similarities there. But a reverse mortgage can be, very problematic to deal with, to facilitate.
Christy, I don't mean to cut you off again, but I will because we have a timely question. If we could go back one slide. Sure. We just had a question about how easy is it to, basically transfer an existing HELOC or get rid of an existing HELOC and get into the Manulife One product. So I think it's kind of two scenarios, whether someone has a HELOC or whether they have an existing mortgage, like what fees are associated there and when could it make sense versus not?
Yeah, so with us, there's no fees at all. So there's no application fee. We cover the cost of the legal, the appraisal, and that's something that's specific because of your relationship, Bronson, with Manulife Bank. So any referrals that come from a financial advisor, we cover those costs. Typically, if you have a HELOC or a mortgage with another financial institution, they typically will charge a discharge fee. That's kind of across the board, regardless of what it is. I would say that's roughly between $300 and $400. You're not going to be out of pocket that. We will essentially absorb that into the Manulife One, pay that out. If you're in the middle of a traditional mortgage and mid-term, so your maturity isn't up, there generally is a penalty that is associated with that mortgage. Now, for us, we've gone through this scenario, and some of those penalties from some lenders are actually ridiculous. And what I've seen $40,000 before, and I just can't wrap my head around how they can come up with some of these numbers. So sometimes we've had to say to clients, it doesn't make sense to do this right now. Let's diarize to follow up in a year or 2 years, whenever your maturity is, and we'll talk then, because you're not going to save that amount of interest in the next X number of months or years. Let's just diarize it to follow up. So I always say, ideally, once that term is up. Sometimes, though, when we run the math and we do the cost benefit analysis, if the penalty is nominal, which I've seen that a lot as well, we can save that amount in interest costs within the first few months. So we really run through the scenarios and see what makes sense for that particular client, because it's not a one size fits all. So sometimes it might be, let's pause and revisit this in a year or so from now. So just to reiterate, you're going to have discharge fees across the board. That's for all lenders. If you're in a traditional mortgage, if you're not at your maturity, then there typically is a penalty. Every lender is unique. We would need to inquire with that. We can go through that process. And if it's ridiculous and it doesn't make sense, we just hit pause. You're not on the hook for anything. We just basically cancel out the application or put it on hold and revisit it at another time. And there's no commitment. You can choose not to move forward with us in the future. There's no cost to you for that. Awesome. Does that cover off those questions?
It does. Thanks for that.
Okay. Yeah. Okay, so just really quick, setup costs. A reverse mortgage comes with significant setup fees such as legal, appraisal, administrative costs. I've seen it close to being I would say $3,000, $3,500 just to set it up. With Manulife Bank, as I talked about, we cover the legal fees, the appraisal fees, and we don't have any initial setup fees at all. Withdrawal requirements. So generally, reverse mortgages, they have scheduled withdrawals that clients have to take. I've heard of clients take it, they have these scheduled withdrawals, but they didn't actually even need it. So they were like, how do I stop it? You got to talk to that company. I'm a different company. So with Manulife One, there's full flexibility. You can kind of push and pull as you need money or if you don't need money, right? So completely flexible. It's not scheduled withdrawals. However, I do have clients that have set up sort of a recurring funds transfer out of the Manulife One into their CIBC account on the first of the month. Maybe it's like that retiree that's taking that monthly draw. We can set those up. It's whatever the client wants. They can stop it at any time. So full flexibility. Access to funds. Again, withdrawals are scheduled with a reverse mortgage. And if additional advances are permitted, they have to contact the company. Manulife One comes with debit card you can use on that ATM network. You can do online transfers, write checks, bill payments. Repayment, often restricted with reverse mortgage. They don't want you to pay off that. Like they're in it to make some good money. With Manulife One, it's completely open. You can borrow the money. You can pay it back the same day, the next day, 10 years from now. So it's completely open and flexible. I'm just going to jump ahead because I want to take a moment to think about how most of us actually manage our money. And if you're like many Canadians, your finances probably look something like this. You have multiple accounts, maybe a few credit cards spread across maybe even more than one bank. Now, this setup is what we call the traditional approach to money management. It's what most of us are taught. It feels very familiar, but it's actually more expensive than you may realize. Your income is likely going into a checking account, which we have established is earning you no interest. It's kind of like a parking lot for your money, just waiting to be spent or allocated. And you can borrow money from the same lender and you're paying a high interest rate on that money. But there's a completely different way to look at your banking with Manulife One. It's really designed to help make the most of your income each and every single day. So if we break it down, Manulife One is really helping you to get your money working for you and not just the bank. When we set it up and we set up that line of credit, something that any bank can do, but where we're different is we allow you to consolidate everything into it, savings, lines of credit, maybe a car loan, everything into one account. So now your savings are actually sitting there and actively reducing your debt. It's not sitting idle in a savings account anymore. And we allow you to use that line of credit as a fully functioning checking account. Now, this means that every time you get paid, every time there's money that's deposited into that account, it immediately reduces your debt. And since interest is calculated daily, the less you owe that day, the less interest you pay. So it's really like using your money more efficiently. But some people like the structure of a traditional mortgage, and you can still lock in any of your debt, a little bit or all of it into a fixed rate. So with Manulife One, you can kind of have the best of both worlds. You can have a hybrid mortgage, flexibility and stability. So as this slide shows, your income flows into the Manulife One. From there, it covers your bills, living expenses, even your retirement savings. Now it's all in one place, working efficiently and transparently for you. Now, I just want to go over the monthly statement that we have. I think it's a powerful tool. I've done an example here where this client does have some debt. You can see how the account can work in those instances. When you open the statement, first thing you see is how much you owe at the beginning of the month. Here it's around $155,000. Now this is the sum of all of your debts laid out clearly. Next, you'll notice that you have monthly income of just over $5,000. Remember, this is your fully functioning checking account. The moment that $5,000 hit your account, it immediately reduced your debt, and it's giving you a sense of that progress right away. Of course, we have to spend money. There's expenses, and that's what we see here, $3,463. So you earned the 5,000, you spent the 3,400 on expenses. So now you're only paying interest on the $153,642. So with this approach, you're free from a separate mortgage, a separate line of credit, car loan payments. These are now just your usual household expenses. And this program is really designed about balancing your income and your expenses. And the wider you can keep that gap, you'll be amazed at how quick you can pay off your Manulife One. Now, the bolded number, that's generally when I open my monthly statement where my eyes go first. That shows you how much in pure principal you've chipped away at that month. So that's where the motivation factor goes in, and it's almost like a challenge in our house. How much can we pay off this month? If it's not as much as we thought, then we open up that statement a little further. We look at all of the transactions, and it gives my husband and I an opportunity to course correct on a monthly basis instead of an annual basis when you're used to getting a mortgage statement and having that sight line into your finances.
That is unique. Christy, maybe we'll pause there and just see if there's any questions. I do have one that came in. Question about going back to moving to Man One. Is it possible for someone to keep their existing mortgage in place and just move only their HELOC?
So if it's a traditional mortgage and I don't want to drop the names, not a HELOC, then we can go what's called second position behind that traditional mortgage.
Okay.
So that is something that we can explore. Yes.
However, if there is a product from an institution that takes a look at sort of your global limit and has some in a mortgage, some in a HELOC, but under the same sort of product, then that's not an option. Is that what you're saying?
Correct. Yeah. And it's because of the way they're registered on title, they're collateral charges instead of conventional charges. And we can't go behind, we're a collateral charge. You can't have collateral. So.
Okay. So we may have to look at that one on an individual basis.
Yeah. Definitely.
Awesome. Does anyone else have any questions? I know everyone is muted. I hope you have the ability to unmute if you're comfortable, or feel free to ask away in the chat function. We have another couple minutes before 1 o'clock, so I want to be respectful of everyone's time. But if anyone has any questions at this point, please fire away. Forget the magic number for like silence until someone will just feel the urge to ask a question.
I'm very
it's like it's not that
silence.
long either. I want to say it's like 30 seconds or something.
Sometimes 30 seconds can feel like an eternity, but I'm pretty comfortable in silence. I have teenagers, so
I hear that. Okay, well, was there anything else? If we don't have, okay, I see someone's typing. We got Ryan with a question. How long was that? Was that about 20 seconds?
I feel like you were close to that. Yeah. I just wanted to put up this screen grab because people were like, Exchange Network, I've never heard of that. What is that? So this is a map grab I took of Windsor area. It's an area that I service with advisors, just to show you actually how robust that network actually is. You might see some of the ATMs in Circle K's or the old Max Milk. And just know that if you're a little bit old school, like my Uncle Sean, you like to walk into a teller and deposit funds there. Manulife Bank actually has an agreement with Royal Bank that our clients can deposit funds, so cash or checks, with the tellers at RBC. You just need to have the deposit slips that we can get out to you, no charge for that.
Awesome. So Christy, we have from Ryan, any legal fees involved switching to Man One?
No, so that's something that is unique because of your relationship, Ronson, with Manulife Bank. I say that specifically because we also work with mortgage brokers, but we don't cover those legal and appraisal fees through the broker channel. So if if a client's being referred to us through the advisor channel, through you, Ronson, That's something that we would cover, so there would be no legal fees. The only time that there's legal fees is if it's a new purchase. So not a refinance or a lender switch, but somebody's buying a new home. You always need to have your own lawyer to facilitate that. The only other time I can think of is if there's a separation. Everybody always needs their own lawyer for a separation.
Yeah, for sure.
We've done this where we're getting it to give somebody access to equity for a buyout. Everybody always needs their own lawyer when it comes to, we're not covering those legal fees. Or if somebody's over the age of 75, this is an industry standard for protection of the client to make sure that they're not being taken advantage of by a family member. They're of sound mind, can enter into this contract and understand what it is. Those clients will require what's called independent legal advice, ILA. That's something that they do have to incur that cost themselves. It's usually a couple $100 to go to a lawyer and get a sign off on that.
Got it. Okay. Second question, client who already holds a mortgage with another major lender, how does Manulife enable access? Specifically, is it designed to work alongside an existing mortgage, or does it require refinancing and restructuring? Any other practical considerations that clients should be aware of? We sort of answered that one. So my understanding, make sure I understand this as well, is if you have an existing mortgage, Manulife can take a second position.
Mhm.
If you are near the end of the term of your mortgage, you can full on switch over to Man One. So it kind of depends on the style product that they have. If it's a clear cut, dry, normal standard mortgage, yes, it can be designed to work alongside. If it's more of a complex product where it has multiple tiers like mortgage plus HELOC, then maybe not. So it's kind of depends on the situation.
You
Is
got it.
that
Yep.
bang on? Sweet.
Bang on. You got it.
Okay, Ryan is a mortgage broker actually. And his
Okay.
question is, Ryan, if you want to maybe just clarify what you're getting at here, if the client came from Bronson. Ryan, if you want to maybe clarify if you're referring to like your own situation or one of your clients, like if it makes sense to refer to me or do it yourself. If you could just clarify, please. So Alex asks, are you going to include this option in estate planning if there are significant capital gains implications? So yes, it kind of depends on the scenario. If we're looking at, it depends on what we're looking at really here, right? Are we looking at, second properties? Are we looking at a non-registered account? It would depend. In any case, we would sit down and figure out what are we actually looking at, where are the capital gains coming from, what's the estimated capital gain position, and make the decision based on that. In any case, though, if the goal is access to more money in a tax efficient way, this can be a great solution for that. So, Alex, maybe we can take that one offline and look at the situation more specifically. Richard has, what exactly is the second position so we can all understand? Would you like to clarify that one, Christy?
Yeah, so second position would be essentially that's in order on title how it's registered. So let's just say you have a traditional mortgage, easy numbers, your home's worth $1 million, but your mortgage with that traditional mortgage lender is 200,000. Well, essentially you still have equity there. We can essentially look at doing a second position to open up access to an additional 600,000, because with any sort of refinance, you can only do 80% of the value of your home. So we can look at setting up a line of credit for that 600,000. So that's essentially what that second position means, meaning we leave that traditional mortgage in place, but we've opened up this line of credit kind of behind it on title in second position so that you have access to the equity in your home.
Awesome. So Ryan is saying in a scenario where Ryan, as a mortgage broker, is recommending a Man One solution, are the legal fees also waived for mortgage brokers, or is that something only offered through the advisor broker network?
It's only offered right now through the advisor channel. So on the broker channel, we work with a lot of great brokers, but unfortunately, it's not something that is covered. So I always like to be clear because sometimes somebody may be on here and they might go to their mortgage broker and hear, oh, but no, Manulife covers. So there is that distinct difference. But whoever your professional is, go back to them, talk to them, find out if this is the right solution for you, and then we can kind of take it from there. But as it stands, those fees are only waived on the advisor channel if that referral is coming from a financial advisor.
Ryan, you can call me later on that one. Excellent. Any other questions? I mean, some of these I'll likely be reaching out to everyone on an individual basis. And if there are any more personal questions or scenarios you want to dive into, we can definitely look at that. But, I think this was a great call. Christy, thank you very much for your time and your efforts in putting this information together for everybody. I think it was super valuable for me and for my client base. So I really do appreciate it. And if anyone here has any additional questions, feel free to reach out to me directly or just wait for my email to you. This is a recorded call, so you will have access to this later on. With Christy's approval, I'll put it on YouTube, whether it's on a private basis or public basis. But I always like to make sure that we're sharing as much value as possible. Because this is information that it makes no sense for us to not share, because it's a very, viable and usable solution for most people out there. So I hope you got some great takeaways. Again, feel free to reach out anytime. Christy, again, thank you very much.
Thanks, Bronson. Thanks, everyone, for your time. Appreciate it.
All right, everyone. Have a great week. Take care.
Take care.